And that's 11.54% of the stock price. So that's a pretty nice cumulative hedge. I have that cushion to the downside. I didn't look at this as a conservative investment. I looked at it as a strategic speculative investment. And the first call sale was definitely very speculative, but by the time you're taking in another round and another round, it was much less speculative because it was additive to the premium I collected before that. And there's another factor that came into play on this particular trade. This was one of those new entries into the rare earths mining, this company. And it's an industry where it kind of requires old guard staying power because it's long cycle projects. It is capital intensive. So I had in the forefront of my mind that this is definitely somewhat speculative. And like I said before, it was heavily shorted as a result of that. So on top of collecting premium, I was also loaning the stock out to short sellers.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 53, Lemonade Stands and Other Moments of Trauma. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, make sure you're subscribed to the show in your favorite podcast app. You don't want to miss anything. And if you're already subscribed to the show, you can go even deeper and get more out of what we talk about with a paid subscription. With your paid subscription, you get video extra podcast episodes, so you can get hands-on video training on things we talk about on the show, subscriber-only posts where I drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades like credit spreads and much more. And the best part is your paid subscription helps keep this show on the air. So I'd like to take a minute and thank our newest paid subscribers from this past week. A big, warm thank you to Mohammed A., to Victoria R., to Christian L., and to Jeff W. To join this list of Wealth Building paid subscribers, just go to the Wealth Building with Options Substack page and sign up. The shortcut to that page is wealthbuildingpodcast.com, and just choose your monthly or annual subscription. For the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching, our Smart Income video class, and get on the wait list to get a signed copy of my new book, Build Consistent Wealth with Options, scheduled for release on April 28th, 2026. For those of you who maybe didn't start binging this podcast from episode 1, the structure of this show is designed around the book I just finished. Again, that book is called Build Consistent Wealth with Options and is due out April 28th of 2026. That is this year, for those of you who are listening in or around the actual release date of this episode. I've been going in order of the chapters in the book and covering quite a bit of what's in the book. I make it friendlier for an audio podcast as opposed to the medium of reading written words on paper or a Kindle. And of course, when it's helpful to have a visual aid, I create a video extra podcast episode for our paid subscribers, of which we have quite a few. And I mean both video extra episodes and paid subscribers. Last week, we left off sort of at the end of chapter 13. But I think there's some useful stuff to cover left in that chapter. So for today's show, I want to pick up where we left off last week, talking about covered call opportunities. And yeah, covered call opportunities that don't suck. And then I want to jump into the stuff that I have in chapter 14, which is a little bit of a shift into new territory from where we're going to start this episode. We'll be covering some of the costs involved with trading the wheel and how to overcome them. There's a saying in business or project management that goes a little something like this: when everything's important, nothing's important. And that's definitely true when you're trying to get stuff done and you're thinking about a million things and you only have so much bandwidth to do it. But this is an educational podcast, not a project. And to me, everything I put in the show is indeed important. So we're going to have a well-rounded show today that covers a good handful of topics. So without further ado, grab your machete. We're getting into the weeds deep. Much like we talked about last week with cash secured puts, with covered calls, we also can think in terms of what outcomes we get once we put a trade on instead of what management we have to do. We can think about setting up a win-win type of trade that is very strategic right from the onset. In 2024, I was analyzing match stock MTCH. The fundamentals were, average at best, I would say. But technically, the stock was bullish, and they reset their corporate governance, making some perceived positive leadership changes. After selling a couple rounds of cash secured puts and bringing in somewhere around $2.50 of cumulative option premium, I got assigned. And I ended up buying the stock at about $38 a share. And wouldn't you know it, the stock ended up selling off after that. It bottomed out below $27 a share. Oh my goodness. The thing about fundamentals, though, is that they get better as the stock price falls. Those price on top ratios, they get better. So I decided to wait out the storm. In the meantime, I sold several rounds of calls and collected dividends, paid its dividends. And it was not a great investment by any stretch of the imagination, but I was making it work. Fast forward to several months after that, and the stock had finally staged its comeback. The company posted an earnings beat, resulting in a gap higher. With the stock above $37 a share now, I decided that I would get a little more aggressive with my options overlay strategy. And in early August of 2025, I sold the December 37.5 calls at $2.67. So they're pretty close to the money, just a little out of the money. I didn't love the stock fundamentally or technically at this point, but I wasn't desperate to sell it either, especially if I could take in $2.67 on a stock that I effectively owned for around $35 a share. That is, after accounting for all the cumulative option premium I collected. I was adding still another $2.67, bringing my effective purchase price, or the break even, to more like $32.30 or something like that. And that's not even counting the dividends I got. Another way to think about it is by selling the December 37.5 calls, I was taking in 7.63% on that effectively $35 share investment over the 139-day life of the calls. That makes for an extra 20% annualized return on the results, unless, of course, I got assigned. But hey, if I did get assigned, my if called return would be $40.17 or so. Again, the stock on its own wasn't a home run or a brilliant investment. It was more what a magician might call the misdirection, so the options could do the trick. I'd be pretty happy selling a stock at $40.17, making 20 some percent and being done with the whole thing. And this is one of the beauties of using the wheel. It's not just about the stock, it's also about the option premium. Here's another example. So when rare earth metal mining companies started really getting hot and the stocks were really making some pretty aggressive up moves, well, implied volatility was also rising in that industry. I bought some shares of USAR, which was trading at around $12.56 a share. And I do have the guideline that we talked about in earlier episodes that, hey, I don't like to do the wheel on stocks that are below $30 a share. But in some of these situations, the math just overrules any guidelines I have set up. And this was one of those situations. My concern was that the company was kind of a newer rare earths company, and it's a pretty capital intensive business. It's a long cycle project business also. And they didn't have great fundamentals by any stretch of the imagination. And there was a lot of short interest, actually. The reasons for the strength in the industry, too, I mean, they seem to make a lot of sense. I mean, the U.S. government was investing in some of these companies, and there was a lot of talk about the importance of mining for rare earths and processing rare earths in the U.S. and not relying on China and such. But hey, you know what? Sometimes these things just end up being fleeting sort of scenarios. So this was definitely a scenario that had its risks to it. But I'd hoped to participate in some upside price appreciation if the strength continued to build. So I held on to the stock for a bit, and the stock got a bump, rising a little more than $1 from where I bought it. So I sold the 13.5 calls that had 23 days to expiration at 70 cents a share. And I was thinking about this a couple of different ways. First, around 70% of the rise in the price of the stock ends up being hedged by that option premium, because 70 cents of the dollar rise is hedged, right? Selling the call at 70 cents. Another way I was thinking about it is that 70 cents represented 5.57% of the $12.56 that I originally paid for the stock. And annualized, that's an 88.44% return on this kind of risky investment. Further, if the stock took off to the upside, I'd have sold the stock at an if called return of 13.06%. And again, that's on an investment that I would have only held for a couple of months. So let's fast forward the tape here, 23 days later, and I bought those calls back for a nickel and I sold another round of calls at 80 cents. This time they had 36 days to expiration. That brought in another 6.37% return on the investment, the original investment of $12.56. So that annualized is 64.58%. But more importantly, if I think about this from a cumulative premium perspective, at that point, I had $1.45 banked, even taking into account the 5 cents that I paid to buy back the first round of calls. And that's 11.54% of the stock price. So that's a pretty nice cumulative hedge. I have that cushion to the downside. I didn't look at this as a conservative investment. I looked at it as a strategic speculative investment. And the first call sale was definitely very speculative, but by the time you're taking in another round and another round, it was much less speculative because it was additive to the premium I collected before that. And there's another factor that came into play on this particular trade. This was one of those new entries into the rare earths mining, this company. And it's an industry where it kind of requires old guard staying power because it's long cycle projects. It is capital intensive. So I had in the forefront of my mind that this is definitely somewhat speculative. And like I said before, it was heavily shorted as a result of that. So on top of collecting premium, I was also loaning the stock out to short sellers. And I was still able to continue selling calls on it at the same time. So in return, I collected option premium and interest. Now, generally, with a stock that's sold short by a lot of people, the bigger the percentage of what they call the float, which is the shares that are available for trading, the bigger the percentage of the float that is shorted, the higher the interest rate you get for loaning out the shares. It's, supply and demand, right? So I was earning an annual rate of return of over 120% interest at some points on this sucker. Yeah. And that's on top of the 88.44% or 64.58% or whatever it was I was squeezing out of the options. So this is a prime example of a two-pronged strategy that was really very, very strategic. And those of you who've been fans of the show for a while or know me from my work with Market Taker Mentoring or read my Substack or whatever, I'm not telling you the story to brag or anything like that, because I also share the stories of the times that I goofed up so that you can learn from my mistakes and my successes. But this is a really, really great lesson to take away on some things that you can do when it comes to covered calls and cash secured puts. This is a two-pronged income strategy. And again, there's definitely a lot of risk to it, but that double dip return, it ended up being really worth the risk. Moving right along, I want to start this section of the show out telling a little bit of a story. So I know people who they say, oh, my father was a great man and I try and emulate him and that kind of stuff. And, I'm envious of those sort of relationships. I had a different relationship with my father. I definitely got some very good and useful personality traits from him. But, we just didn't have that kind of relationship. But here's a story that, I don't know, it kind of illustrates the good and the bad of the relationship, I guess. I don't know. You be the judge. So I was probably around like 10 years old, something like that. And I was just kind of born with the entrepreneurial spirit. I guess being a kid of the 80s, that's when it was a little easier to be an entrepreneur. Now they squeeze the crap out of you. But I decided that I would set up a lemonade stand down at the end of our street. Not that it was a really busy street, it was probably more charity than anything. People were feeling sorry for me sitting out on the corner of a cul-de-sac in a subdivision that got about 5 cars a day driving by it. But anyway, so I said, yeah, hey, mom, dad, can I borrow a folding table and a chair and a pitcher? I'm gonna set up a lemonade stand. I got some poster board. I'm gonna make a sign. This is gonna be great. So my father said, oh, well, how are you making the lemonade? I said, oh yeah, I saw a container of country time lemonade, the powder mix. I found it over there in the pantry there. I was just gonna make that in the pitcher. My father said, oh, I see. But that lemonade, that country time lemonade, well, that's my lemonade. So, I mean, are you going to pay me for it? And he wasn't kidding. So, long story short, I paid him for it because it was his and I was planning on making money off of it. So, it was actually fairly reasonable in hindsight. I made money. I put it in the bank so that I can earn interest on it. And again, this is the 80s. There actually was interest paid at the bank. And I was saving up because I wanted to buy some numismatic coins. I was all into that when I was a kid, or maybe even a Star Wars action figure because I was also kind of into that. But it's kind of a little bit of a glimpse into my childhood. And, stuff like that played out pretty regularly. And to tell you the truth, I feel that this was actually a really great lesson. And in a way, I know that this is a time where we think differently about how we impart lessons on the younger generation, but I think this is a good lesson. In any business, you have costs. And the person who has the thing that you need to make money isn't being a jerk for charging you to use it. It is their thing. And if you use it to make money, I mean, why shouldn't they get paid for the use of it, right? Well, trading is a business. And it works that way there too. In trading, you have expenses. But for the most part, they're more nuanced than buying powdered lemonade off your dad. To begin with, you need a tech stack. You need a decent computer that has a decent enough processor, fast enough internet. You also need a funded account. You need money, right? The most important thing you need, though, is knowledge, because honestly, you can always get money. And you can get money to fund your accounts and to buy the computer. But the knowledge, if you don't have that, nothing else works. Nowhere that I know is there more of a direct relationship between knowledge and financial reward than there is in trading and/or investing. There's tons of sayings out there about this. Investing in yourself pays the best dividends, et cetera, et cetera. But investing in education, I'm all about that. And I highly recommend that for anybody. But there are other expenses too. And for the most part, most of them are what you call variable expenses, meaning the more you make, the bigger they get, or at least the more you trade, the bigger they get. These variable expenses fall into a couple of categories, a few categories. Taxes are one. Commissions and fees are one. And what we call slippage is one. So the good news is there are ways to manage each of these to lessen the impact that they have on you. I want to start out talking about taxes, and I think then we're going to wrap up and cover some of the other stuff and really delve into some stuff next week. But I kind of need to predicate this a little bit first. I'm going to tell you that I am not a tax expert. What I do is I hire a good accountant to do my taxes. And unless you have that skill, I recommend that for you. And all the things that I'm going to suggest here are from the perspective of somebody who knows that he's not an expert and that hires somebody else who is an expert. So this is going to be some general thoughts, but I think that this can be very, very helpful to people who are not familiar with these thoughts. I'm going to point you in the right direction so that you can ask your accountant the right questions to help legally minimize tax liabilities. So trading in a tax-free or tax-deferred account obviously can have its advantages. For me, most of my wheel trades, not all of them, but most of them are in a rollover IRA. For those of you who are listening from the US here, you're probably familiar with what that is. For those of you outside of the US, if you're not familiar, it's a retirement account that has some tax-deferred advantages. The wheel, because it's a long-term strategy that's made up of series of short-term trades, cycles of short-term trades, there can be some weird tax implications if it's not in a tax-deferred account, because there can be short-term capital gains that could be taxed at a higher rate than long-term capital gains. And you have both with the wheel, right? You have a stock that you might hold for 10 years, but you might sell 2-week calls over and over again on them. So that's why there is definitely a potential advantage for tax-free or tax-deferred accounts. And like I mentioned, the specifics vary country by country. And let's face it, laws change all the time. Even if you think, oh, well, they'll never take away IRAs. I mean, they probably won't, but you never really know. They could come up with something different. So laws change all the time. You're listening to this 10 years from now, who the heck knows what the situation is. But another thing is talk to your accountant about whether setting up your trading as a business or electing trader tax status is a possibility, and if it even makes sense. Because when you do, I've talked to some people, and it's then possible to write off some trading related expenses. Potentially. Again, depends on jurisdiction and such. Also, consider potential tax benefits of trading underlines that have tax benefits. There are some that are called 1256 contracts. Options on at least many of the broad-based indexes fall into this category. However, this is where it gets a little bit tricky with the wheel. Options on broad-based indexes may not be practical for some wheel trades because in some cases you can't own the actual underlying of an index. Like SPX is a perfect example of this. SPX are options, broad-based indexed options on the S&P 500. The underlying for SPX options is a number. It's basically a concept. It's just the value of the index. It's not the physical shares of anything. You can, however, own interest in the S&P 500 other ways. Like you could own shares of SPY, which is the ETF, a tenth the size of SPX. But if you write SPX calls that are 1256 contracts against shares of SPY, well, that's not a covered call, even though it kind of almost is, but it's not. In a standard Regulation T margined brokerage account, shares of SPY and the short SPX calls, they would be margined individually. So it'd be margined as if you're short naked calls in SPX. And naked calls tie up a whole ton of capital and might not even be allowed in your account if it's a retirement account like an IRA. In some accounts, it could be possible to execute a strategy that mixes and matches the underlying with different classes of options if you have what they call portfolio margining. Some people call it retail portfolio margining. But those cross-product risk offsets, they're not something that's guaranteed. Like, you have to talk to your broker about what they allow, see if you can even get portfolio margining, what's allowed once you get portfolio margining. And portfolio margining has certain requirements, including minimum account value size, which some companies are $100,000. I think some are $200,000. It all varies company to company, brokerage firm to brokerage firm. But portfolio margining, if I'm not mistaken, is not allowed in IRAs in the US. But again, it doesn't hurt to ask your broker. And that about wraps it up for this show. But before you go, please make sure you're subscribed on your favorite podcast platform, whether that's Spotify, Apple Podcasts, or whatever it may be. And hey, if you would be so kind as to leave a comment, I would really, really appreciate it. Let me know what you like about the show or what you'd like to see more of. And to do that, if you're on your phone and you're on Spotify, I think you can just scroll down and find where the comment section is, and you'll be able to leave one there. It's not necessarily always intuitive, but if you scroll down, I'm on my iPhone on Spotify, and if I scroll down, there's a section for comments right there. Until next time, friends, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read Characteristics and Risks of Standardized Options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.